How's it going, everyone? It's Sam. We are going to look at Dave Ramsey's mutual funds, his 12% mutual funds, he calls them, and we're going to compare it to the index, so the S&P 500 index. So first of all, before I get into it, I get lots of hate whenever I talk anything bad about Dave Ramsey or about really any stock market investor or any YouTuber. So first of all, I just want to say I applaud Dave Ramsey. He has been in the game and in the finance space longer than just about anyone. He has done probably the most good for the most amount of people of anyone in finance. So right off the bat, I'm just going to say he's doing an awesome job spreading awareness and spreading just general finance knowledge throughout the community. However, there are some things that I highly disagree with Dave Ramsey about. And before you comment, well, you don't know anything, he's a millionaire. You don't have to be a millionaire to realize when someone's telling the truth or someone's trying to kind of push their own agenda. So we're going to go through and compare over the last 10 years his 12% mutual fund versus the S&P 500 index. So let's just get started. I'm going to show you a couple of videos of his where he talks about the index funds, or the mutual funds actually, that he has invested in and how easy it is to get a great rate of return.
And I'm going to recommend a good growth stock mutual fund that has an average annual return of 12%. I own one that's done that for over 75 years.
Okay, now we're just going to show the next one here.
And I own several mutual funds that have averaged well over 12% in the scope of their lifetime. And many of them are very, very old, 50 or 60 or 70 years old. And
so right there, he talks about how he's had multiple mutual funds that have done really well over time, which is totally true. Any mutual fund could do well over the last 100 years because there have been so many. So there are thousands upon thousands upon thousands of mutual funds. The question is, which one's going to do well in the future? Now, he's never explained or talked about the exact mutual fund that he describes. However, you can find it because he's made it pretty clear what the metrics are on it. And really the only one that fits this is the Investment Company of America, or VTSAX. So first of all, you would have had to find this mutual fund out of the thousands of mutual funds. And if you're thinking, oh, I'll just look at the one that has the best rate of return, well, the one that had the best rate of return last year really most likely won't have the best rate of return this year. Otherwise, everyone would be investing in it, obviously, right? So everyone's trying to make money. If it was that easy, you could have just done that. So first of all, it would be really hard to find this. But let's go through exactly what it shows and kind of talk about the mutual fund in general. But before we do that, if you guys don't mind hitting the like button right below, it really helps out the channel. And if you do want some free stocks from WeBull, there's a link in the description below. You can get 2 free stocks, one worth up to $1,400 if you deposit $100. So I appreciate it. So right here, we have the Investment Company of America. As we look here, the expense ratio is 0.59%. Now that's each year they're taking 0.59% away. And as we go down, it's mostly large cap stocks. It's got some medium, so that means mostly large companies, very stable companies. Now, as we go down here, they have about 95 billion in assets. And as we go further down, you can see the 1-year return, 3, 5, 10, and so on since the fund inception, about 12%, so just under it now. Now, keep in mind as we go down that this is from the company website. So they'll show things that are true but kind of shade to the side of this mutual fund. So as we can see here, their price to book is lower, which is better. Their cash flow, or their price divided by cash flow, is better. Their price divided by earnings is better. As we keep going down, we can see Morningstar has them at 3 stars across the board. And as we go down to their equities breakdown, you can see they're really heavily into the largest companies in the world, the Microsoft, Facebook, Broadcom, Amazon, Alphabet, Netflix, a lot of things that you've probably heard of, and they've done really well over the last few years. So good for them for doing that. Now, as we continue to go down, we can see that most of the geography of the investing is in the United States, a little bit is abroad, and we can also see the dividends here. We can also see the fee breakdown. So you can see that they charge about 0.59%, like we said, and that's generally what it shows on here. So we're going to compare that to VTSAX, which is just a fund by Vanguard. It holds some of the largest companies in the world, and it has an expense ratio of 0.04%. So this is a total stock market index fund, and it's just really well diversified. As you can see here, it's spread out through all the different sectors. It also has Microsoft, Apple, Amazon all across the board, and it gets into smaller companies here. But this is generally just a very good stock market index fund to look at if you're looking to invest long term. So I will say too, earlier I mentioned an S&P 500 index fund, and this is actually the total stock market index fund, which has small cap and mid cap, so it's more than just the 500 largest companies. So I think that's just something to note here. Now what I did was I compared every year the rate of return from each of these two different funds. So I started in 2010, and I went a year out, and then I went a year out, and a year out, and a year out, and I tallied up how much money you would have after that time. So if we take a look here at AIVSX versus the index, we can kind of compare them side by side. So first of all, the sales charge. AIVSX, Dave Ramsey's fund, charges an upfront premium or an upfront fee of 5.75%. This is just for investing in the fund, while the index charges 0. So this is a really large amount. So on $10,000, you would have to pay $575 just right off the bat. It means less if it does well over time. So if it does better than the index, then it's less important. But if you're continuing to put money in, it's a huge drag on the portfolio right up front. Now next, we can also take a look at the management fees. So like I said before, 0.59 compared to 0.04, another thing that draws it down dramatically. Now, what I did was I took those prices each year, and day one, this is what you start out with. So if you invest and they take the fee out right away, you have about $9,366 in AIVSX, and this is in 2010. And in the index, you have about $9,996. So essentially $10,000. So as you can see here, end of year one, you did very well in AIVSX compared to the index, which did really a lot worse overall. And with these numbers that I went through here on the chart, these are with dividends reinvested. So I took the stock price, I took out the management fees, and then I added back in the dividends that these companies made over time. Dave Ramsey's fund pretty much breaks even the second year, but the index does pretty well. As you can see here, it surpasses Dave's fund. As we go down the line, you can kind of see the effects of the management fee here kind of dragging down, and this is just really short term, so it's not as important short term as it would be long term. But as we continue to go down, you can see the funds diverge further and further apart. And as we continue to the bottom, you can see that the index did about 3 times better than it started with for an average rate of return of about 12.85%. And these numbers might be a little bit off depending on when you watch this, just because I researched it a few days ago. So depending on what the market's done, it could go up and down. Compared to the annual return of AIVSX, which did about 5.3%, the index did almost 13%. So this is a huge amount that the index beat Dave Ramsey's fund on. Now, again, this isn't indicative of future results, but I will say that generally if you have to pay more in expense ratios for a company or a mutual fund, it's generally not a good idea. These index funds usually do just as well, if not better, than the hedge funds or the mutual funds. So the fact that they have fees on the mutual funds usually drag down the performance, and the index does better. Now, one reason that I think that Dave might talk about this is, one, just to try to provide some kind of structure for people to say, okay, you can do really well in the stock market, but he goes out of his way to continue to say 12%, which really isn't accurate. Even the S&P 500 over the last 100 years or so hasn't gotten close to 12%. It's closer to 9 or 10%, and it usually does a lot better than these mutual funds. So it'd be very hard to continue to do 12%, even if you had gone in the past with AIVSX, but it would be very hard to do it in the future, just because the likelihood that the mutual fund that did well in the past is going to do well in the future is very low. Now, another reason Dave Ramsey might talk about this is so that he can bring people over to his website. So he talks about how to invest in mutual funds. He talks about his certified advisors all the time, and he gets a commission when one of his certified advisors sells something. So he gets part of that money. So if he can say, yeah, we get 12% average, that's normal, and then people are like, I'm only getting 8 or 7 or 6 or something, I'll go over to Dave's funds and I'll get 12%. Well, he gets a cut of that. So he has a large network that he works with and a lot of people that pay him commissions. He's done quite well in that way. He has a lot of affiliate marketing that promote his different companies, and he's able to really cash in on that a good amount. So again, don't hate me for saying this. I'm just comparing the index versus that mutual fund, but it's really difficult to say that you're going to get 12% in the mutual fund. More likely, you might get 8 or 9, and then the index will get 10. But we don't know what's going to happen in the future. But it's interesting to compare Dave Ramsey and what he says compared to what you can actually expect. So again, please let me know in the comments what you think about this. Hopefully you don't roast me too bad for kind of pointing out something wrong that Dave Ramsey said. I do have a lot of respect for him for everything that he's done and everything that he continues to do. I just think that when it comes to investing, he might not be the least biased person to talk to. He has a lot riding on whether you invest with his advisors, and he just generally doesn't give great knowledge about investing. I mean, I watched him for a while until he talked about not investing in your 401k, even if there's a match, if you have some kind of debt that has 5 or 10% interest rate. So right then I thought, okay, I can't really watch this anymore. This isn't correct in my mind. So that is where I kind of draw the line with Dave Ramsey. But I appreciate you guys watching. Thank you for commenting and hitting the like button, and I will see you in the next video. Thanks.